Are you leaving money on the table with your real estate investments? Taxes can feel overwhelming, but with the right strategies, you can minimize your burden and maximize your returns. What if we told you there are powerful, proven methods that successful investors use to keep more of their hard-earned money? Ready to unlock the secrets of real estate tax strategies that work? Join us as we explore 7 must-know tax strategies for real estate investors, ensuring you keep your investments profitable and thriving. Depreciation deductions unlocking hidden savings. Depreciation deductions are one of the most powerful tools real estate investors can use to save money on taxes. This isn't just a minor perk. It's a game changer for anyone in the rental property business. Picture this. You're earning steady rental income, your property's value might even be climbing, and yet you're able to claim a tax benefit for its so-called decline in value. It almost feels like having your cake and eating it too, doesn't it? Here's the fun part. The IRS allows you to write off the cost of your property, minus the land, over a set period of time. For residential properties, it's spread out over 27.5 years, and for commercial ones, it's 39 years. That means you take the value of your building and divide it by those years to calculate an annual deduction. Let's break it down with an example. If you own a rental property worth $300,000 and $240,000 of that is for the building, you're looking at a yearly deduction of around $8,727. This isn't money you're spending out of pocket. It's a non-cash deduction that reduces your taxable income, leaving more money for you to reinvest or enjoy. There's even more good news. With strategies like cost segregation, you can supercharge these savings by accelerating depreciation on items like appliances, roofs, or flooring. This means instead of waiting years to claim the full value, you get bigger deductions sooner. Think of it as a turbo boost for your cash flow in the early years of owning a property. When done right, this can free up serious capital to help you expand your portfolio or tackle other financial goals. Depreciation deductions are like a hidden treasure for savvy investors, offering significant tax savings that make your investment dollars work even harder. If you haven't been using this tool to its fullest, you might be leaving money on the table. Get familiar with how it works, and you'll see how depreciation can make every property in your portfolio a little more profitable and your path to wealth that much faster. The power of 1031 exchanges. The power of 1031 exchanges is a strategy every real estate investor should have in their back pocket. Imagine selling a property, reinvesting the proceeds into another one, and deferring those hefty capital gains taxes. Sounds like a dream, right? With a 1031 exchange, it's not just possible. It's a proven way to grow your portfolio faster and smarter. This strategy lets you keep more of your money working for you instead of handing it over to the IRS. Here's how it works. When you sell an investment property and use the proceeds to buy another one of equal or greater value, you can defer paying capital gains taxes on the sale. The trick is to follow the IRS's timeline. You have 45 days to identify potential replacement properties and 180 days to close the deal. It might sound like a tight window, but with a little planning and the right team in your corner, you'll be amazed at how seamless it can be. This is especially exciting for investors looking to upgrade their portfolios without losing momentum to tax obligations. The beauty of 1031 exchanges lies in their flexibility. You're not locked into the same type of property either. You could sell a single-family rental and exchange it for a multi-unit building or even a commercial space. The possibilities are vast, and each exchange helps you grow your assets while deferring taxes that would normally chip away at your profit. Every time you roll your proceeds into a new investment, you're building equity and wealth, all while the tax bill waits patiently in the background. 1031 exchanges are like hitting the accelerator on your investment journey, letting you leverage your gains to reach the next level. With this strategy, your money stays in the game, working harder for you year after year. If you're serious about building long-term wealth, the 1031 exchange could be one of the most valuable tools in your arsenal. Keep learning, keep strategizing, and watch your real estate empire grow without skipping a beat. Deducting mortgage interest, a built-in advantage. Deducting mortgage interest is one of the easiest ways to boost your bottom line as a real estate investor. This built-in advantage can significantly lower your taxable income and let you keep more of your hard-earned money. If you're financing your properties with a mortgage, you're already in the game for this tax-saving perk, so why not maximize its potential? It's a win-win, where your loan payments help build equity and save you money during tax season. Here's the exciting part. The interest you pay on loans for investment properties can be deducted as a business expense. Whether it's a small rental or a commercial property, you can claim those payments and reduce your taxable income. This isn't just about small savings here and there. It can make a significant difference over the years, especially for investors managing multiple properties. With real estate, every dollar you save reinvests into your growth, and deducting mortgage interest keeps more of that cash working for you. It's not only about the current tax benefits either. Deducting mortgage interest pairs beautifully with other strategies like depreciation and 1031 exchanges to create a layered approach to tax optimization. Imagine trimming down your tax bill while continuing to build a strong, diversified portfolio. The money you save can be used to expand your investments, renovate properties, or just improve your financial cushion. The possibilities are endless when you have a plan. Mortgage interest deductions also highlight how much the tax code favors real estate investors. It's one of those hidden gems that gives you an edge over other types of investments. By understanding and applying this deduction, you're not just saving money, you're making a smart move toward financial freedom. Dive into this advantage, get familiar with the details, and watch as your investments become even more rewarding year after year. The benefits of pass-through tax deductions. The benefits of pass-through tax deductions are an absolute game changer for real estate investors, and you definitely don't want to miss out on them. This tax-saving strategy allows you to deduct a portion of your business income directly on your personal tax return, meaning you get to keep more of your profits while lowering your overall tax liability. It is like getting rewarded for being a savvy entrepreneur, and it works beautifully for investors operating under entities like LLCs, partnerships, or sole proprietorships. What makes this deduction even more exciting is how it gives you access to the Qualified Business Income Deduction, or QBI for short. This allows eligible investors to deduct up to 20% of their business income. Yes, you heard that right, 20%. If your real estate business qualifies, this can mean thousands of dollars in tax savings each year. Think of all the possibilities that come with those extra savings, from reinvesting in new properties to upgrading your existing portfolio. It is like turbocharging your real estate strategy with the power of smart tax planning. One of the best parts about pass-through deductions is how they level the playing field for small to mid-sized investors. You don't need to own massive properties or run a big corporation to benefit. As long as your business is structured correctly and meets the qualifications, you can take advantage of these tax perks. It is a fantastic way to offset income while keeping your financial growth steady. And if you pair it with other strategies like depreciation or mortgage interest deductions, the results can be nothing short of phenomenal. Pass-through deductions are proof that the tax code is designed to reward entrepreneurial spirit, especially in real estate. They encourage you to take risks, create value, and build wealth. So, if you're not already tapping into this incredible benefit, it's time to dive in and learn how to structure your business for maximum advantage. Saving more on taxes means having more resources to chase your dreams and grow your legacy. And that's a win you can truly celebrate. Cost segregation, accelerating depreciation for bigger savings. Cost segregation is like unlocking a secret weapon in your tax strategy arsenal, and it can save you tens of thousands of dollars if you know how to use it. This powerful method lets you accelerate depreciation on certain components of your real estate investments, giving you access to bigger tax deductions much earlier. Instead of waiting decades to spread out depreciation, you get to classify parts of your property, like fixtures, appliances, or even landscaping, into shorter depreciation timelines. What makes this strategy so exciting is how it breaks your property into smaller pieces, each with its own timeline for depreciation. For example, instead of grouping everything into a 27.5 or 39-year depreciation plan, cost segregation allows certain assets to be depreciated over 5, 7, or 15 years. That means larger deductions in the first few years of ownership when cash flow matters the most. Imagine being able to keep more of your rental income in your pocket rather than handing it over to Uncle Sam. Sounds pretty amazing, right? To really make the most of cost segregation, you'll want to bring in experts. Tax professionals and engineers can analyze your property to identify which components qualify for accelerated depreciation. While there is an upfront cost for the analysis, the potential tax savings can far outweigh the expense. It is an investment in your financial growth. Plus, this strategy works for both newly purchased properties and those you've owned for a few years, so there's flexibility to apply it when the timing is right. Cost segregation isn't just about tax savings. It is about using the extra cash to fuel your next big move in real estate. Whether you're planning to acquire another property, make upgrades to your current portfolio, or simply enjoy better cash flow, this strategy puts you in the driver's seat. It is like hitting the fast-forward button on your financial goals, and every investor who wants to build lasting wealth should consider it. Utilizing real estate professional status. Utilizing real estate professional status can be a game changer for savvy investors looking to supercharge their tax strategies. If you qualify as a real estate professional under the tax code, you open the door to deducting unlimited passive losses from your active income. This means that expenses like mortgage interest, depreciation, and property repairs could significantly reduce your tax bill, giving you more financial freedom to grow your portfolio or enjoy the fruits of your labor. Achieving this status is not as complicated as it might sound. To qualify, you need to spend more than 750 hours a year actively managing your real estate investments and have it as your primary business activity. This is perfect for those of you already knee-deep in property management, flipping houses, or expanding your rental empire. Think about it. If real estate is your passion and your profession, why not reap the full tax benefits it has to offer? It is about turning your hard work into tangible savings. One of the most exciting aspects of this status is how it transforms the way your losses are treated. Normally, passive losses are limited, meaning you can only offset them against passive income. But with real estate professional status, you can apply those losses to your active income, like earnings from a day job or a business. Imagine the potential savings if you could significantly reduce your taxable income. It is not just about numbers. It is about unlocking financial potential that can change the trajectory of your investments. By taking advantage of real estate professional status, you are not only maximizing your tax benefits, but also positioning yourself as a true expert in the field. It is an opportunity to align your career with your financial goals and create a tax strategy that works as hard as you do. Whether you are just starting to dive into real estate full-time or you are already in the thick of it, this status is a powerful tool that every dedicated investor should explore. The savings and opportunities it creates could be the key to achieving your financial dreams. Leveraging opportunity zones for tax-free growth. Leveraging opportunity zones for tax-free growth is one of the most exciting strategies available to real estate investors today. These zones were created to encourage investment in underserved areas, and they come with serious tax perks for those willing to dive in. By investing in opportunity zones, you can defer capital gains, reduce your tax liability, and even eliminate taxes entirely on new growth if you hold your investment long enough. It is like giving your portfolio a double boost while making a positive impact in communities. When you invest capital gains into a qualified opportunity fund, you can defer paying taxes on those gains until 2026. That means more cash in your pocket now to reinvest and grow. If you hold your investment for 5 years, you get a 10% reduction on the deferred gain, and after 7 years, it jumps to 15%. But here is the real kicker. If you hold your opportunity zone investment for at least 10 years, any appreciation on that investment is completely tax-free. It is not just a smart strategy. It is a golden ticket for long-term growth. The great thing about opportunity zones is that they are spread all over the country, giving you a variety of options to suit your investment style. You might target urban areas ripe for revitalization, small towns on the rise, or even rural spaces poised for growth. As you explore these areas, think beyond the tax benefits. Opportunity zones allow you to be part of a larger story, helping rebuild communities while creating wealth for yourself. It is a win-win that feels good and pays off. Taking advantage of opportunity zones requires some upfront planning, but the rewards are absolutely worth it. Whether you are rolling over gains from the sale of another property or starting fresh with a new investment, this is a strategy that can help you build wealth while making a meaningful impact. By investing wisely and holding your ground, you're not just creating a portfolio, you are planting seeds for a future that could grow tax-free. It is a chance to make every dollar work harder for you, with benefits that keep building over time. And there you have it. 7 powerful tax strategies every real estate investor should know. These techniques can transform how you manage your portfolio, helping you keep more of your hard-earned profits while building long-term wealth. If you enjoyed this video, don't forget to like, share, and subscribe to DwellScape. Hit that bell icon so you'll never miss our latest tips and insights. Until next time, keep thriving in real estate and making your money work smarter.